Good afternoon. This is Dr. Long recording part 4 of the pinch and stretch presentation. This is a series of rapid fire flashcards that illustrate some important points about the technique and strategy. This illustrates the idea that there are times when all 4 regression lines are tightly packed together inside the Bollinger Band Z3 lines, and that we treat that as a consensus fair value for that brief moment in time in which they are all in agreement. The next thing that has to happen is price and the RL10 leaving this congestion zone and making a directional move. If that is followed by higher time frame traders and investors, then we will see the other regression lines join. If they don't believe it, then we'll see the RL10 revert back to the long-term mean, and that will be seen as a head fake. This shows a Z3P Superpinch trade frame intraday, 1 minute charts. We've got the Superpinch here with price compressed, all the RLs inside the box. If we get a breakdown below the red line, the bottom Z3 line, which is also the VWAP, we would see a test of the low, test of yesterday's close, so that's our structure to the downside. To the upside, we would be looking for previous signs of resistance, or we would find the low of the day, add a range stat to it to get an upper reasonable limit for that day's move. This is a Z3P entry, the pinch, the breakout, a stop below at the Z3 line on the far side. This is one I cashed and then did a stop and reverse on the violation of this Z3 line. That led to a directional move, cashed here, which paid for the first trade and some change, and then an owl entry on the rebound. This is a hybrid frog entry into a owl pattern entry here, where we have the RLCO right here. We have the dragon and the 30 both rolling up, and a breakout here. If we were going owl, would be around 10:15. This collapses or compresses into a Z3P, which then becomes a Z3 Superpinch. I treat this as an owl, as that really being the first move out of all this compression. This yellow dot right here shows the Superpinch condition, in which now all the RLs have been compressed inside that tight box. This chart shows the way I get a directional bias by looking at the relationship between the moving RL30 and the simple moving average 30, which is the middle of the river. When the RL30 crosses the Bollinger Band mean, I treat that as a significant event. Here I have an upward bias because the RL30 is greater than the simple moving average 30, greater than the river, and both are sloping up. Here's where it rolls over and crosses. Now I have a downward bias as long as the 30 is below the middle of the river. This is where it crosses back to the upside. I now have an upward bias. Now I have a downward bias. I just want to show that these are moments of pinch, and you can see the moves that leave the station after the pinch. This is an example of an RL10 to RL270 excursion, a significant one. This is about 25 cents worth in EWW, which is about 1 R of risk for us. This one shows an RL10, RL270 divergence that leads into an owl entry and a nice trade. So we have a pinch, we have a breakdown, we have a measured distance from the RL27 to the RL10, the largest one of the day. That leads us into an owl entry, managed with a Z2 stop, and then we get a nice return right back to the RL270 right by the numbers. This one is showing the relationship between RL30s and the dragon, and how the dragon, the hump of the dragon here, and the belly of the dragon here, when they're connected, creates this price channel that is normal. And then we can use the directional relationship between the RL30 and the middle of the river to get our directional biases. You would find owl entries here, 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 and here. And so the owl is sort of our guide on how far does it have to begin reversion to get the entry. Here's one where it's finding support once again at the lower support level, and then our target would be the top of the channel, the previous dragon high, and then it's also linking up nicely with the VWAP. Here is a Z3P Superpinch. You can see the pinch has occurred in the yellow, and then all the regression lines are inside the river. Buying the breakout, it fails to follow through. After about 10 bars, we get a stop and reverse when it re-enters the original Z3P channel. When I see that and I stop and reverse, my target is the far side of this channel, and that's what we got in about another 10 bars. At the yellow, you have a Z3 excursion, and then you got to decide if you want to cash about 0.8R or play for a return all the way to the edge of the channel. I wouldn't let this get further back than Z-2. Here's a Z3 Superpinch. You can see all the regression lines are inside the channel, and the channel is pinched, and we have the breakout from the Z3 lines. That's what gives us that Superpinch and the entry. Here's an intraday relative strength candidate, DuPont, that had pulled back, found support in a Z3 Superpinch. We buy the breakout. Our initial stop is at the bottom of the Z3 channel. We get a nice favorable move when the RLCO pattern 1 happens. We also get the maximum stretch between the RL270 and the RL10, and then that there is no failure and no further follow through, and then you notice how that's creating another pinch. It's not a super pinch because the 270's down here and the 90's up there. So this is a movement from super pinch to a pinch, and you can see how the river has caught back up to it, but the 270 and the VWAP are only slowly approaching. So that's a movement from super pinch to pinch. This is a flashcard on 5 possible exits after a pinch breakout, and we get an excursion to beyond Z3. The 5 places we can exit is upon re-entering the Z3 and just cashing the win. That's a strike entry. We could do a 1, 2, 3 exit. We could get price entering the dragon. We could get price leaving the dragon. We could have the RL10 either entering the dragon here, which is this exit also, or RL10 departing the dragon. We might also look at the RL10 entering the baby dragon here, or crossing the baby dragon, which would give us this exit. So 5 exits, all of which give you the ability to cash a winning trade. On Z3 excursions, depending on what the money management for the day is and the time of day, this is at 2:30, I'm likely to cash earlier rather than later. Quick flashcard on RLFF convergence and divergence. So in the morning with a gap up and an excursion upward, we have the maximum excursion of the RL10 from the RL270 is this yellow distance. That's identical to these yellow distances. So later in the day when we get the Z3 pinch occur, and then the Z3 super pinch when the 270 joins, the orange represents the size of the pinch box. So you can see the Z3 lines are definitely inside of that, and all the regression lines are there. I framed that trade by taking the 270 plus the maximum excursion so far that day, and then the Bollinger Band mean minus that, and that sets up the channel of expected reasonable moves for the rest of the day, which holds all the way through the pinch throughout the day where it was holding that VWAP. I still am measuring to the upside from the Bollinger Band mean and the Bollinger Band mean. Just a reminder of the owl pattern by the numbers. We have the unambiguous move number 1, RLCO outside the river, number 2. RL10 crosses the dragon is 3. Number 4, the dragon starts to hook up. Number 5, the RL30 begins to hook up. In this case, my target is going to be the VWAP. And you notice that later we get to follow through. It comes right to the VWAP. There's that intersection. Here are some Lifecycle trades of various types using the second generation RLCO patterns. There was an owl entry here. We can't see the previous part of the trade, but there was an owl entry here. Now the RL10 touches the dragon, but then resumes and comes back out of the dragon. I treat that as a pocket entry or a continuation or a confirmation of the first trade if I didn't exit. This failure to fail is important, which is what creates the pocket after the first successful leg up. On all these long side trades, I'm looking at the RL270 as the initial target as long-term fair value. Notice here it gets there and then begins to collapse. We have an RLXD exit here. We have an owl entry here as price it continues to collapse, and now the dragon and the 30 have rolled over. That's your owl entry down to a Z -2, and then a 1, 2, 3 exit, and you could get a pocket entry here. It's not an owl yet because the 30 has not rolled up and the dragon have not rolled up. Here's where you get the owl entry. A move to a resistance level where the previous hump of the dragon also forms the hump of the dragon here, and the RL30 is above the Bollinger Band mean. We get an owl reversal here or a 1, 2, 3 exit here. If it had immediately reversed and cut back up through that blue line, that would give us an emerging dragon. As it is, we get an owl. Now when this price breaks through the previous swing low of the belly of the last dragon, then that gives us the CD or the collapsing dragon. So you can see how we have owls and dragons of various types and some of the trade frames that we do. This is a Z3P breakout into a 1, 2, 3 exit, or an RL touching the dragon, or RL crossing the baby dragon exit. I like cashing that. This is failure to fail further. This could be a pocket. This is a Z2 excursion and starts to fail. Either one of these is a reasonable exit from this initial. The owl entry would be here, and the target would be back to the top of the resistance channel, the original resistance channel. The owl entry is technically right in about here. Just a reminder on the trade process we use, listing of the questions that we answer for each trade frame so that we are working on our decision making in the expected cases. If we have success or failure, would we stop and reverse? Where would we add? When would we re-enter winning trades? And by answering all these questions, we are systematically and in a disciplined way looking at both angles of the trade, both sides of the trade each and every time. And the final chart looking at the psychology of stalking. As we go through time, we're stalking, we see some initial conditions occurring leaning forward. There's an ideal time for us, the balance between too early and too late. That coincides, I think, somewhere around here with the second mouse. We want to be in the position as third mice, the early majority come in. That's going to be large money, next higher time frame moving in our favor, moving the trade in our favor, while they're still on the favorable part of the return. Fourth mouse and fifth mouse, we'd like to be in not as early as the first mouse, too early. Not as late as the third mouse, although we like it when that happens, when he comes in. In retrospect, it's always easy to see where that tipping point was. In practice, you're going to have to become comfortable with some anxiety associated with those trades in order to be in early enough to get the sweet spot of the gains. So the psychology of stalking is important. We're stalking, then we're entering, then we're managing, then we're exiting, then we're stalking once more. That's the ritual of psychology in our style. So, thanks for your kind attention. This is Ken Long at Tortoise Capital, completing part 4 of our pinch and stretch strategy. Thanks for your kind attention.